Good morning everyone. Today we are going to learn a very important provision related to designated zone. As far as UAE is concerned, in the business there are a lot of free zones, especially in Dubai there are many free zones. So some of the free zones are controlled by customs and entry and exit of human, and the movement of goods are controlled by fencing. So those are customs controlled free zones. And some other free zones, most of the free zones in the UAE are not customs controlled free zones. So as per the UAE law, UAE VAT law, the free zones are divided into two. One is designated zones, other one as other than designated zones. So there are some special provisions which are applicable only for designated zones. Those are mentioned in the Article 51 of the Execute Regulation of the VAT law. Before understanding the provisions related to designated zones, let us understand how the transactions are there in the mainland. See, in my example, the central position is inside the state, that is UAE. The left and the right is considered as outside the UAE. So in this example, I am going to discuss when materials are importing from outside the world, that is outside UAE to UAE, it has to be recorded under reverse charge that we already discussed. When we are selling materials from UAE, that is in the mainland, to outside UAE, that is to other than implementing state, it will be an export that will be zero rated. At the same time, within the UAE, within the UAE, if any purchases happened, then the supplier has to charge 5% from the customer. Now let us understand how the tax applicability in the case of designated zones. Let us consider the purchases. In the case of goods, the purchases. See, in my example, the center point is the designated zone, and in one side you can see the world outside UAE, the other side you can see UAE. So UAE, designated zone, outside UAE. Let us see how the purchase impact will be there for the VAT for the designated zones. Here, the goods are purchased either from the mainland or from the designated zone or from outside the UAE. Suppose the first purchase is happening from outside the state, then such a purchase will be out of scope. There should not be, the tax applicability will not be there for such purchases. Second, if the purchase is happening from the mainland, that is inside the state, from the inside state, the designated zone is purchasing some products. In that case, 5% tax will be applicable. So the buyer, that is a designated zone, has to account and can take the input credit. Next one, if any sale is happening within the designated zone, that means our company is going to buy from a designated zone registered supplier. In that case, it will not be taxable, because within the designated zone, if the materials are sold, it will not be taxable unless it is used for consumption. The same way, if the purchase is happening from another designated zone also, there will not be tax. Now let us see, while selling the products, how the tax will be applicable in the case of designated zones. See the transactions. The center point is designated zone. One side UAE, the other side is outside the UAE. So here let us understand how the tax applicability will be there. See, the designated zone, a company is registered in the designated zone, that is selling the products to another company which is located outside the UAE. In such case, it will be out of scope. The tax liability will not be there for the designated zone company. Even though the sale is making to an individual outside the UAE, still the tax liability will not be there. It will be an out of scope sales. At the same time, if the registered company in the designated zone is selling to a mainland company or to an individual, overall the tax impact will be 5%. At the same time, the designated zone company registered one is selling to another company registered in the designated zone, there won't be tax. But if such a sale is made to an individual for consumption, definitely 5% tax has to be collected by the designated zone company and paid to the authority. At the same time, if such a sale is made to another company within the designated zone, but if such a sale is made for consumption, then also 5% tax has to be collected and paid to the authority. The same will be applicable in the case of another designated zone also. 5% tax will be there if it is used for consumption, otherwise no tax on such sales. Listen here. So far we were discussing about the transactions of goods from the designated zone to mainland or designated zone to outside UAE or between designated zones or within the designated zones as well. But in the case of services, all services from the designated zone company will be treated as at par with the state. That means for any service done within the designated zone will be treated as similar the transaction taken in the mainland. That means 5% tax liability will be there for transactions for the services done in the designated zone. In short, designated zones have got special provisions, and some of the transactions will be taxable and some of the transactions will not be taxable. In the case of services in the designated zone, everything will be similar to the mainland transactions.